Intel, the turnaround stock with a market cap of $119 billion, a PE of 6, and a dividend yield of 5%, just reported Q3 numbers this week, and Wall Street was surprisingly happy with the results as the stock popped 10% after hours. The business beat on earnings, but it had a decline of 15% in revenue. So, seeing as this is one of America's leading chip makers, what do we make of Wall Street's earnings reaction, and should we as value investors be buying the stock now that year to date we are down 45%? We'll answer all those questions and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. We'll start by doing a full analysis into the financials, the top line, bottom line, balance sheet, cash flows, etc. And finally, we'll end up concluding with an evaluation of this business using our intrinsic value calculator to see if we really should be picking up shares of Intel. And if you enjoy this type of content, make sure to subscribe because we post on here regularly, providing our in-depth analysis on the business fundamentals of varying businesses. So again, if that interests you, like, comment, subscribe, and without further ado, let's jump into the video. And as always, we will start with Intel's CEO's comments just to provide some context on this quarter. And they just mentioned that despite the worsening economic conditions, they delivered solid results by their standards, and that to position themselves for this business cycle, they're aggressively addressing costs and driving efficiencies across the business to accelerate their IDM 2.0 flywheel, which is their plan to expand Intel's manufacturing capacity by building those 2 new fabs in Arizona, and so far has costed them about $20 billion. And they say that IDM 2.0 is going to allow their business units to be more agile, make better decisions, and establish a leadership cost structure. All right, so they basically outlined their strategic priorities here, but we always want to measure the management's integrity by the performance of the business historically. And we can see here, despite this slowdown right here where we didn't grow too much, since 2016, we have been able to grow consistently in terms of revenues. However, that did not translate so well in terms of bottom line. We can actually see we had a slowdown here up until about 2017, 2018. Then we had a nice pop once we had a chip shortage and whatnot in 2019, but since then, again, we're just kind of stagnated and we haven't been able to grow, and that's why they're trying to invest more into this business, trying to prop up those numbers a little more. All right, so let's talk a little bit more about what we can expect from Intel if we were to invest in this business. Well, near term, they're expecting a cyclical slowdown considering there are macroeconomic headwinds, but in the long term, they're saying they have sustainable demand for their products, that their total addressable market will increase to pre-pandemic levels, and that there's still some demand for their products. Now, how exactly are they going to make sure that this transformation actually comes to fruition and they don't let shareholders down? Well, they're taking actions to reduce their costs across COGS and operating expenses, and these efforts should drive savings of $3 billion in 2023 and up to $8 to $10 billion annually by the end of 2025. If they can actually pull this off, we can already anticipate that there will be some significant stock appreciation because the fundamentals will naturally improve drastically if they're saving on costs. Now, let's put some context to what's going on with their different segments. So let's look at the top 3 segments so far. They have Client Computing Group, which is essentially their PC business. These revenues are actually down 17% year over year, from $9.8 billion down to $8.1 billion this quarter. Operating margin actually shrunk down to 20% as well. Keep that in mind as we'll talk about that more in just a minute, but we can see here that they had lower demand for their products. The next largest segment we have here is their Data Center and AI Group. These revenues were down 27% this quarter from $5.8 billion now to $4.2 billion this quarter. Again, operating margin actually shrank all the way down to 0%. That is absolutely terrible. Finally, the third largest segment here is their Network and Edge Group. Revenues are actually up for this at least 14%, so that's a great sign. But they're only up from $2 billion to $2.3 billion, while their operating income is now down 85% to just 3%. Again, more issues here for Intel on the back end. And again, it's because they had softer demand than they expected. But let's take a full picture look here by looking at the income statement. And as you can see for this quarter, again, $15 billion in revenue, down 15% from that $19 billion a year ago. Then we have cost of sales, $8.8 billion. We're left with gross margin, $6.5 billion last year, 10.7. Again, more declines here. Research and development has increased, and the restructuring charges have also substantially increased as well, leading to operating expenses of $6.7 billion. That leaves us with $175 million of operating loss by the end of the quarter. Last year, this time, we had $5.2 billion in operating income. So at this point, you're probably wondering, didn't you say at the beginning of the video that this stock is up 10% after hours? And yes, I absolutely did say that. And you're not the only one scratching your head. Even though they had an operating loss of $175 million, without this provisions for tax benefit, this actually was a quarter where they had a net loss. Now let's move on to the balance sheet here. We have cash and cash equivalents plus short-term investments, which equal up to about $22 billion in cash. Then we have short-term and long-term debt that make up about $40 billion in debt. So while this isn't the worst thing you'll ever see from a balance sheet, Yeah, they probably have 2 times the amount of debt that they do cash, but they are investing substantially right now, trying to build up those fabs. So of course they are going to take on some debt to do such things. Not to mention that their business is also going through some hardship right now with near-term and long-term headwinds. So this is kind of what you can expect from this business in terms of their balance sheet. Now let's jump into the cash flow. We can see they were able to produce cash from operations again of $1 billion. Deduct our capex here of $7.2 billion. You can already see what's going on with this. We have a free cash outflow of $6.3 billion. Not much you can really do with that, but let's take a look anyway at what they did with their financing activities. Well, they've taken on some more debt here, and then also they repaid out a dividend. And this is my main gripe with businesses that don't have enough free cash flow to reward shareholders. You know, they have to go and take on debt to pay out the dividend. That is never a great thing to see. It's actually a sign of declining fundamentals, which clearly Intel is going through. It's kind of like taking out a loan to pay off another one. And in this case, I think it's just better if they just cut the dividend and really focus in on improving the free cash flow and the bottom line of this business, because right now it looks terrible. With that being said, let's take a look at their fiscal year 2022 outlook. They're saying they're on track to reach about $63 to $64 billion in revenue, which will equate to gross margins of 47.5% and an adjusted free cash outflow of about $2 to $4 billion, which means if they don't have any free cash flow to reward their shareholders, what do you guys think is going to happen to the dividend? There's no possible way that they can continue this business going in the trajectory that it's going while also taking on debt to pay out a dividend. So based on that information, I am expecting that they're going to cut this dividend because they clearly cannot afford it. But we've now gotten to that point in the video where we need to make an evaluation on this business. And the best way to do that for a business like Intel, where they're going through some structural changes, is to look at their historical performance, primarily in the years of 2017 to 2016, because this is where they're projecting that the revenues are going to look like by the end of the year. So if we look at operating income here, we can estimate that they should come in with between 18 to $13 billion. Let's just call it $15 billion in operating income here. So if we assume that for the next couple of years, they can produce $15 billion in operating income on an average basis. And if we require a 10% return, currently they are paying a dividend, but for this calculation, let's assume that they're not paying a dividend. And if we assume that from these levels, they can start to grow at 3% per year, then especially into 2025 and further, as they save on costs and whatnot, they can actually start to grow at, let's call it 7%. On a 15 PE, the stock should be worth about $35 per share. Right now, we're trading at about $29 per share. So we're actually kind of trading at a margin of safety right now for an expected case if they can produce about $15 billion in operating income. Now, in the best case scenario, they're able to save, $8 to $10 billion in costs per year. The economic rebound really boosts this stock. People start buying more of their PCs. They're seeing benefits from IDM 2.0, etc. Let's assume that this business can start to grow at, let's just call it 7% for the first 5 years. Then after that, we're able to grow at, 15, 16%, let's call it, for the 5-10 years after that. On a 20 PE, the stock would be trading at about $78 per share. So in the very best case scenario, we could actually see this stock appreciate, probably do a double and potentially even a triple from these levels if they make good on their promises, etc. Now, in the very worst case scenario, we see further declines in this business, further deterioration, less customer demand, etc., etc. We see a decline for the first 5 years about 5%. That normalizes out at 0% after that. On a 10 PE, this stock should be worth about $11 per share in the very, very worst case scenario with their net debt position on the balance sheet, etc. And this ultimately is the real issue with Intel right now. That being said, if somehow they are able to finance this dividend and actually afford it without taking on more debt, let's add that into the calculation and see how these numbers change. We can see here, this business would still be worth about $30 per share in the very worst case scenario, where they're declining 5% for the first 5 years and then stabilizing at 0%, no growth for the 5-10 years after that. And then if we look at our best case scenario, there's going to be some significant stock appreciation here as well. So keep that in mind if you're thinking about investing in a business like Intel right now. Again, PE of 6, a price to sales ratio of 1, the same thing with a price to book ratio, price to free cash flow ratio of 15. But that is the analysis here for Intel stock. Do you believe that they're going to start to grow from these levels? Do you believe that they're going to be able to make good on their promises? Will this business grow? Will there be demand in this business? Because if so, the stock really can appreciate from these levels, as we've seen in the past. We got up to highs of, $70 per share or so. Or are you of the thought process that we've seen the best days for Intel in the past and they won't be able to compete with businesses like TSM, AMD, Nvidia, etc., and that this business is too old to compete with the new guns? Because if that is your thinking, then we probably will see more of a decline here. I think we're at an extremely interesting point here for Intel, where either scenario could actually work out. But let me know your thoughts in the comment section below. Let's have a discussion. That's my analysis for today's video. If you enjoyed it up to this point, please like, subscribe, as it helps out the channel greatly, and I'll catch you on the next one.